As a retirement savings vehicle, how does an infinite banking account compare with a 401k model? Aloha, I'm Stan Koch, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. Now, doing the research for this video, I couldn't find any kind of graphs or charts that I was looking for. So I'm going to have to create some for the purpose of comparing numbers. But to start with, I'm just going to quote some statistics that I found regarding 401ks. Now, this is according to the Investment Zen website. Just 4 years ago, the average rate of return on a 401k plan was abysmal, minus 0.4%. Relative to the overall return of the S&P 500 over the same time, it fared a little better, as the S&P had a minus 7% return. However, when you look at buy and hold investors, they fared better at a return of 1.2%. Now, I don't know about you, but those numbers don't excite me even a little bit. Of course, that was the last 4 years, and we all know how erratic the stock market has been over the last 4 years. The majority of 401ks are invested in a variety of mutual funds, which are groups of stocks that are traded on the stock market. Now, continuing on with the Investment Zen information, Christine Benz from Morningstar claims that a return of 5% per year is a good number to use for planning. But there are fees charged by many 401k plans, and those fees, when taken over the long term, can cause a serious drag on a portfolio. For example, the SEC, this is all quoted from Christine Benz here, the SEC reports that a 0.75% difference in fees on a portfolio of $100,000 will cost the investor $30,000 over the course of 20 years. Some of the fees that get packed into your 401k plans include plan administration fees, investment fees, individual services fees. Depending on the mutual fund you choose in your 401k plan, you could also be paying the following fees: sales charges or load funds, management fees, 12B point or -1 fees, more depending on the fund of choice. When total, these fees can easily equate to an additional 1 to 2% in charges. Those directly impact your return to the tune of tens, if not hundreds of thousands of dollars over your career, thanks to losses in compounding interest. Now, regarding losses, anything tied to the stock market is at risk of loss. And the timing of losses, which do naturally occur in cycles with the stock market, can really ruin a retirement savings account. For example, if there's a downturn in the markets when your account is just a few years old and you lose 50% of your money, it's really not that big of a deal at all. But if that downturn occurs when you're just a few years from retiring and you lose half your money, that's a big deal. For example, the S&P 500 is down more than 14% year to date as of Monday afternoon, June 21, 2022, while the NASDAQ composite has lost nearly 24% since the beginning of the year. We're not even halfway through the year, and we're not going to try to account for variables like that here. We'll just go with averages of returns. So let's say Christine, quoted a minute ago, is accurate in estimating a 5% annual return. And that actually correlates with other data that I found in researching this topic previously, but it's actually probably closer to 4%. But anyway, we're just going to go with these optimistic numbers, okay? Now, here's some numbers that I got from the Motley Fool website. They use quite a bit more optimistic projection. This is their assumption. Assume that you start with 0 and start a 401k retirement savings and earn $50,000 per year salary. You save 8% of your salary and receive a 3% matching contribution from your employer. You also receive a 2% annual salary increase and can earn, get this, 7% average annual return on the savings in your 401k. That's quite optimistic, actually, but we're going to go with those numbers. Continuing on, well, that, of course, would be in a perfect world. More likely, the average annual return would be 5% at best. But here are the numbers in that perfect world, according to Motley Fool. You would build a 401k balance of $263,697 by the end of the 20-year time frame. Now, I'm going to share a graph here that I made on my screen. Hang on a second. Let's get this going here. We'll share this. And here's the 401k example we're talking about over here. In the perfect world, no corrections, starting with 0, saving 8% of a $50,000 salary, plus 3% employer matching for 20 years, earning 7% annual gains. End value with a 0 starting balance, $263,697. Now, continuing on with the Motley Fool deal here, modifying some of the inputs even a little bit can demonstrate big impact that comes with small changes. So if you start with just $5,000 balance instead of 0, the account balance grows to $283,891. That's better than a $20,000 improvement from the 0 starting balance. Okay. Now let's throw in some reality. Hate to do that to you, but here we go. The stock market typically follows a 7-year cycle where it will experience a correction or a downturn and then start growing again. So if you were to start your 401k at the beginning of a bull market and 7 years in, the market corrects to the tune of 25%, then starts gaining again. Then in another 7 years, at the 15-year point, it corrects again, another 25%. By the way, that's fairly average correction amount. Then it gains again up to and even past the point where you start taking distributions at retirement. Okay, so let's look at those numbers. In that case, the numbers would be more realistically at the end of 20 years, starting at 0, the 401k would have, with the corrections, $153,226. Starting with $5,000 instead of 0, at the end of 20 years, it would be $194,843 with the corrections at those 2 points. See what a huge difference those periodic corrections make in the bottom line down the road? Now, I use just a 25% correction in these calculations, as I said, but we've seen 25 to 50% corrections in just the last 5 years. And as noted previously, there's been a 14 to 24% correction already this year. We're only halfway through the year. Of course, then there's the fees. And the Motley Fool says The average all-in fee is 2.22% annually. And then when you take the distributions as income in retirement, guess what? You're going to have to pay income tax at the going rate at the time of distribution. What's that going to be? All that notwithstanding, let's go ahead and run the numbers for an infinite banking account where the same amounts are being input to the account and based on the same income of $50,000. So let's see if we can change to the next slide. Here we go. So at the end of 20 years, the infinite banking account will have a cash value of $152,409, starting at zero. Starting with $5,000, at the end of 20 years, there would be $163,025. So at this point, it looks like the 401k is the winner here. But remember, we haven't deducted the fees, which come out annually and will reduce the actual growth that will be available to the owner. And then there's the income tax that will be deducted as distributions are taken. Now let's pretend that the income tax rate doesn't go up over the next 20 years, as if that's a possibility, and just 25% goes to the IRS. Now, that leaves you with just, and let me move to the next slide here. Yeah, here we go. That leaves you with just $114,920 in the 401k starting at zero, and $146,132 starting with $5,000. Now, with the infinite banking account, there is no risk that the cash value will ever be reduced due to the stock market. There is a good likelihood that the dividend interest rate will increase and your cash value will grow more than what is projected, but it will not lose value. And when you take money out of the cash value, you don't have to pay tax on it. First of all, the money you put in has already been taxed. Then, after you've taken out what you had deposited in, you would take loans against the rest, and there's no tax on those loans. Another benefit with the infinite banking account is life insurance is included. So even if you take out all that you originally put in, then leverage the entire balance of the cash value, there will still be, based on the numbers for this illustration, over $300,000 of death benefit that will be transferred to your beneficiaries tax-free when you die. Now, I want to be clear, I'm not opposed to 401ks or investing if you can afford to do that. That is, knowing that the money you put into the stock market, whether by way of a 401k or otherwise, is at risk of loss. So if you can afford to lose the money and you already have an infinite banking account, investing can be a good move. But I would always recommend taking care of an infinite banking account first. Now, if you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below here. And the link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. So go ahead and click on that and book a time and a day. If you would like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.